guys, what's up? I'm Erin and welcome back to the channel. If you've been paying attention to the stock market lately, you've probably noticed that practically every day we get a new headline saying the market is hitting all-time record highs. If you look at all the major market indicators, it's pretty clear to see that the market has had a pretty stellar run. In 2021 alone, the S&P 500 is up 27% year to date. The Nasdaq is up 24% and the Dow Jones is up 20%. So if you've been invested all this time, there's a pretty good chance you're doing a little bit of a happy dance right now. And if you've been sitting on the sidelines all this time, perhaps you're thinking to yourself, well, this roller coaster is high enough. It's bound to come down. I should just wait just a little bit longer before I invest. After all, no one wants to invest at the very top of the market just to see it all come crashing down. And what goes up must come down, right? Well, not necessarily. First of all, if this is your thought process, you're altering your behavior based on how you think the market will perform. You're being reactive and you're trying to time the market. And we all know it's nearly impossible to time the market. The pros who literally do this as their career, they literally do it every day, all day, and have every imaginable market insight, cannot successfully do this over time. That is why index funds repeatedly outperform actively managed funds. And if the pros can't do it, why would I ever think I could? Much of the success I've had as an investor is from knowing that I can't beat the market, that I can't constantly pick stocks that will outperform the market over time. Trust me, I've tried. From the moment I started investing, I was convinced that I was going to be the next Warren Buffett. He was my hero. He still is my hero. I started off by reading Benjamin Graham's book. I researched the companies, I read their prospectuses, I voted as a shareholder. I even called the companies, which they probably found pretty annoying, but I wanted to know the answers to my questions. Then I kept on top of these companies, what they were doing, what their management structure looked like, what their future plans were. And after about 8 years of that, I had nothing but a mediocre portfolio performance that at best kept pace with the stock market. But it was a lot of work. Then I started to learn about index funds, and slowly and kind of reluctantly, I converted on over to an indexer. I read the book titled The Little Book of Common Sense Investing, written by a founder of Index Fund and the little company called Vanguard, Mr. Jack Bogle. If you haven't read it, it is a book that I highly recommend. It's loaded with common sense, which I find very hard to argue against. And I decided that I didn't want to spend a lifetime acting like a fool earning subpar returns. So instead of being convinced that I was the next Warren Buffett, I became convinced that I was not the next Warren Buffett, that I didn't know any more than the millions of other investors around the world all competing for the same information. So I converted my portfolio on over to index funds, and instead of trying to beat the market, I simply try to capture the market return. I still do invest in individual stocks. I do it because I love it and I find it fun, but it is a very small percentage of my portfolio, and I do it knowing that I don't have any sort of Midas touch. That was sort of a big long tangent, but the moral of the story is, for the vast majority of people, I think it's nearly impossible to beat the market. No matter who you are, no matter how talented you are, no matter how smart you are. But it does feed into the fact that it's nearly impossible to time the market. Markets operate on a global scale, involving millions upon millions of investors, companies, and all their individual moving components to these companies. Trying to make decisions on how these companies will behave on a micro and a macroeconomic level is nearly impossible. Yes, it is true that the market today is higher than it's ever been. So that begs the question, even if you aren't trying to pick your own stocks, should you hold off on putting your market contributions in, even if you're using EFTs and index funds, wait for the market to pull back a little bit, and then invest the money? Well, let's take a little walk down memory lane. Here's how the S&P 500 has performed thus far this year. It's pretty easy to see that we are pretty much sitting on the top of a pretty tall peak. Back in January 2021, we kicked off the year with the S&P 500 sitting just over 3,700. It's currently over 4,700. So I get it. When people express concerns about the market being high, I get it. Comparatively, it does seem high. But let's go back another couple years to see what happened. Back in November 2018, the S&P was sitting at roughly 2,700. So that means from November of 2018 to January of 2021, it gained 1,000 points. If we go back like this, we see that what we may now consider at this year's starting point, a low 3,700, but comparing it to 2018, it was quite high. It showed quite a great deal of growth. But what about the S&P sitting at 2,700 in 2018? Surely that was low. Well, let's go back in time and see. If we compare January 2009, the S&P was sitting at just 850 points. So what we see today as quite low, that 2,700 from 2018, is actually greater than 3 times its value just 9 years earlier. High and low are all relative terms. I fully understand when people talk about the market being high today. It is high today. We are at all-time highs. But I would never sit on the sidelines with my money sitting in cash, not invested, waiting for the market to turn, because I have no idea when that's going to happen. In 2018, 2,700 points seemed high because it was at the time. But if you would have opted to wait to invest, it would have been a mistake because the market went on to achieve new and greater heights. If you would have invested $10,000 at the end of 2018 into an S&P tracking index, it would be worth roughly $19,700 today in November 2021. The S&P has had a phenomenal history, these past 3 years especially, posting a 31% return in 2019, an 18% return in 2020, and a 26% return thus far in 2021. And certainly these returns are higher than the expected market return of 10%. And I'm not saying to invest because of these extraordinary returns. It's unlikely that these types of returns will continue going forward. But not investing today because the market is quote unquote high misses the point of the stock market. The stock market is a collection of all of our nation's businesses. Our GDP, or gross domestic product, is a measure of our nation's economic activity, the measure of all our goods and services produced. Our nation's GDP and the stock market are correlated. When our nation's GDP increases, so too does our stock market. If the GDP declines, so too does the stock market. Most of the time. They are correlated, but they don't move in perfect tandem. As we all know, our stock market has wild swings, and it is affected by far more than just our nation's GDP. Think government policies, consumer sentiment, etc. But nonetheless, the value of the US GDP has steadily been on an upward trajectory since GDP was first measured back in 1929. By the way, back in 1929, our nation's GDP was roughly $1 trillion. Today, it sits around $20 trillion. Back in 1929, the Dow Jones sat at just 380 points. Today, the Dow Jones sits at over 36,000 points. Think of all the value that's been created during that time. The world of 1929 is almost unimaginable to those of us sitting here in 2021. When you put your money into the stock market, specifically into index funds that track a large portion of the market or the entire market, you are betting on the American economy. You are betting on future progress, technological innovations, workers increasing their output. You are betting on America having a more prosperous future than she has today. Yes, the market can be seen as high today, but do you think our country will continue to innovate and make progress? I do. That's why I continue to invest. High is relative. What is seen as high today could very well be seen as low in the future. Does that mean the market will never go down? Of course not. Over the long run, of course, we are going to experience bear markets and pullbacks and lots of market turbulence. If you invest in the stock market, you know it is never a smooth ride upward. But I continue to invest because I believe in the future of the American economy. I believe in America progressing forward. That is why I believe that a high today is nowhere near what a high in the future will be. So what are your guys' thoughts? What do you think about the market highs today? I truly believe that it will be much, much higher in the future. That's why I invest. Let me know your thoughts in the comments down below. I always read those comments and I reply to as many as I possibly can. That's gonna wrap up this one. I post new videos every single week, always on a Monday, sometimes on a Thursday. I hope you got anything at all out of this one. Please give it a like on your way out. If you're new here, please consider subscribing. Or if you know of anyone who might get something out of this type of content, please consider sharing, as it really does help the channel. I hope you guys have a great week, and I'll see you soon. Bye.